Wells Fargo Securities' Mike Mayo joins us at Post 9. They're seeing deposit outflows, too, according to the data, Mike, that Steve just looked at.
Well, look, when it comes to banks, Goliath is winning. The largest banks are benefiting. And in the battle of fear versus greed, fear has pounced greed. But my forecast is that greed makes a comeback when it comes to large bank stocks. And you get earnings starting a week from Friday, especially from J.P. Morgan and Citigroup, two of my favorites. I think you're going to see decent revenue growth.
I thought Bank of America was your favorite.
No, we've reordered things. I mean,
Okay.
I have shifted from, it was Main Street banking was the theme, but the recent events and the bank failures, now Goliath is winning. So, we like Citigroup, we like J.P. Morgan, we like PNC, we like U.S. Bancorp. Those are four big players. And when you look at the largest banks, including Bank of America, I still recommend it, but the change in regulation for them is not so much. And they have benefited from an inflow of deposits. And by the way, credit quality is still good. So you're going to look at results, I think, a week from Friday and the following week and see 10% year-over-year earnings growth. And you're going to say, banking crisis, what crisis at the largest banks? And there's some misperceptions out there, and I want to get one thing straight. It's quiz time. Are you ready?
We generally don't enjoy quizzes, but okay.
Okay, so...
We interview you. That's how this works. Yeah.
So when I look at a group of banks, 40%, not banks, 40%, a group of companies, 40% would be insolvent if you took out all of their intangible assets. In other words, negative tangible equity. What group of companies am I talking about? This is an easy question, right? I'm a bank analyst. What group?
Banks.
No, the S&P 500. 40% of the S&P 500 has negative tangible equity. So if you want to do a burn down or liquidation analysis on banks, I know it's not apples to apples. These are different companies. But just keep in mind that a liquidation analysis is night and day different than an analysis based on ongoing concern. There are intangible assets. There's unrealized intangible assets. There are core deposits, relationships with real consumer and payment customers. There's patents.
That's not the debate, though, is it?
No, and the valuation.
The debate is just their earnings profile with sharply lower margins.
Well, now it is.
Yeah.
Well, we're moving from a period of bank crisis to bank recession. But if I see one more article that cherry picks the unrealized losses at banks without giving credit for the unrealized gains, it's like everyone's a bank analyst. The good news is I can talk about arcane bank accounting with the person on the street. Now, I have something in common with some of my family members now, but otherwise, this idea of a liquidation analysis is crazy. The other thing that really needs to be clarified, J.D. Power has indicated that over two-thirds, over 80% of people out there think that the FDIC is just another government agency. In other words, we're all paying our taxes now, and they think their taxes are going to help the banking industry. The FDIC is 100% funded by the banks, led by Jamie Dimon and J.P. Morgan. So the banking industry is resolving this crisis on its own. So I think this is an opportunity. I think when banks report, greed will take a lead up again, and you're going to see the largest banks at least do quite well.
I'm thinking back to last year when one of the big issues was expense control, and you were on a tear about expense growth at some of the big banks. Does that change now as well?
Well, I upgraded J.P. Morgan with the news of the Silicon Valley Bank failure. That's been the right call so far. They have benefited. Jamie Dimon's CEO letter today says we had record revenues. Well, they didn't report that. They also had record expenses. Having said that, these are lesser issues compared to the strength and stability of the largest banks. And one reason is they've had so much regulation, that they are stronger. And the change in regulation ahead for, Citigroup and J.P. Morgan, Bank of America, and the others will be, not much compared to the rest, the next, after the top 10 banks, the next dozen.
Right.
And the other point that's underappreciated, back to that liquidation analysis that's taken place, the government has really turned things around. In 3.5 weeks, you set up a Fed backstop, you resolved problem banks and sold them. Credit Suisse, a big systemic risk, is resolved. You had debates in the House and the Senate. The White House came out with something, and they're all doing it with an eye to the future without upsetting near-term markets. The White House statement from last week, their fact sheet, said, we think banks should have, more capital after, quote, a considerable transition period. So Jamie Dimon's CEO letter said regulators do not have a knee-jerk reaction. I think he's might be concerned about that. He's probably more afraid of what might come. Do not make big changes, Washington, D.C., in the midst of this jittery market. You're one headline away from causing a retracement and concern, so everybody should be hypersensitive to what could disrupt markets.
This is what you argued last week, and that is resolve some of the problem players, right? And no immediate capital raises in your view. Is that right?
That's correct. You don't change your game plan midstream. And that includes the FDIC. The FDIC has a program where banks have to build up the insurance fund by 2018. Now, there's probably going to be special assessments. But you know what? Even if you had another Silicon Valley and another hole, banks could fill that hole where they need to be by 2028, with 1 quarter's worth of earnings. So in other words, the industry has resiliency to resolve, and pay off the depositors and even the uninsured depositors at Silicon Valley and Signature. And I agree that's not a permanent solution by any stretch of the imagination. But to get through this short period, the industry has enough resiliency to get by. And Jamie Dimon reminded you today, this is not the global financial crisis. As you know, I testified to the Congressional Committee about that. It's much less players, smaller issues, and when we get from bank crisis to bank recession, we're going to talk about commercial real estate. We're going to talk about lower net interest margins. We'll talk about maybe a contraction in credit because as banks build up capital, they reduce the amount of lending they do. But those are lesser issues compared to the one of, is my money safe in the bank? And right now, you've seen less money flow. So I think things have stabilized. It's day 7, really a stability, but vigilant is how everybody needs to be, especially as you get through this earnings period and we see how some of the smaller banks perform or not perform.